Michel Rauchs from the University of Cambridge to start us off.
So yeah, I'm going to talk about factors driving cryptocurrency blockchain evolution or revolution. So you may notice the R is in brackets. So hopefully by the end of tonight, we're going to find out whether it's a revolution or an evolution. So just before starting, I usually like to separate really these public blockchains and the cryptocurrencies that live on them with, from these permissioned blockchains or distributed ledgers or share replicated ledgers, whatever you want to call them, because I think these are completely different beasts. So it makes sense like looking at them separately. So let's first start with public blockchains. What are they? Well, they're pretty complex systems, but we can actually simplify it by really dividing it up into four key or core components. So the first one would be the P2P network, nodes directly connected to each other. There's no central server, so basically every node has the same rights. Then you have the famous blockchain, which is nothing different than just a very specific data structure consisting of blocks of data that are cryptographically linked to each other so that they form a sort of sequential chain. And actually that chain represents entire transaction history, so it forms a kind of ledger. Next we have what we call distributed consensus. So in the context of cryptocurrency, that's usually called mining, can be either proof of work or proof of stake, two most common ways of doing it. So you basically have to spend a resource in order to create new blocks. So proof of work, that would be computational power, and proof of stake, that would be financial resource. You need to stake some of the coins. And then finally, of course, we have the native assets or tokens or whatever you want to call them. So these are really the kind of fuel that keep all this system together and that you get as a mining reward, so on which all these economic incentive designs are based. So before we talk really about use case and how far we are in terms of adoption, it's really important to stress what exactly have they actually been designed for, because that's something that's not being talked a lot about. But there's one thing, and it's censorship resistance. So that's really the core idea, goal of a public blockchain, is we want to have something that's censorship resistant. Now, it's like a term that gets thrown around a lot, so what does it actually mean? Well, two things. So there's like no single party that can either prevent or censor a specific operation. And so I'm using the word operation itself just like payments to make it broader. And similar, no single party can confiscate or just like seize a particular resource. And again, I'm not just saying asset, but it could also be another resource such as computational unit, a storage unit, or whatever. So how do we achieve censorship resistance? Well, that's achieved through just removing a central authority so that there's no party in control that can do either of the above. So that's usually what we call decentralization. Now, we can have censorship-resistant payments, for example, what Bitcoin, Monero, Litecoin, well, actually a lot of cryptocurrencies are doing. We can also have censorship-resistant computations or smart contracts, was what Ethereum, NAM, Tezos were supposed to do, and like a lot of other blockchains as well. And then finally, storage as well. So these are just like three examples where censorship resistance could make sense or would actually be needed. So there are a lot more. But the thing is, why don't we just decentralize like everything? Because it just comes handy, right, if you don't have a central authority. Well, the thing is, it's no free lunch. So decentralization really comes at a high cost. So if you look at public blockchains, they're always very inefficient. This is because data is really replicated across hundreds or even thousands of different computers. Every single node needs to perform every single computation, every single, verify every single signature. So everything is like really duplicated all along, which is not the most efficient way of doing it. Public blockchains are always slower than centralized alternatives or centralized systems. So first you have latency between the nodes, P2P network, but then also the block times, they are always bigger than 0 seconds. They are always, or like in most cases, more expensive than centralized systems because again, you have the distributed consensus where you need to stake resources in order to process transactions and verify them. But also, let's not forget about the network infrastructure. So instead of having just some centralized servers, you really need to have, well, each single node runner needs to maintain and run their own node. They are uncertain. What I mean by that is that there's no real settlement finality there. So that means that although you have something that's called probabilistic immutability. So basically, with each additional block, the likelihood of past records get actually changed just decreases exponentially. But the thing is, it's not impossible. So if you spend a lot of resources, you can still, in theory, change past records. So there's no real settlement finality. And finally, they are very difficult to scale. So a lot of people are actually saying that, oh yeah, Bitcoin is just like too expensive, it's too slow, let's just move to another coin who doesn't have these issues. Now the problem is that every single public blockchain will run into exactly the same scaling issues with growing usage. So it's not like a silver bullet that if you have a different design that you just can't scale, can just magically scale actually. So the thing is, if it's that complicated actually to have decentralization, and if blockchains are so inefficient, now the thing is, why do we actually use them? So there's like a guy on Twitter who said that they are terrible at almost anything. Actually, I was at a conference in Riga a few weeks ago, and there was a Bitcoin maximalist saying, what if we could just take the blockchain out of Bitcoin? So like Bitcoin without a blockchain, it would be the best thing ever, because that would solve a lot of problems. Which is actually funny because we hear all the time that actually, no, it's the blockchain that makes everything magically better. So what's now the case? Well, the thing is, there's two main reasons why you would actually want to use a blockchain, and that's first, as we've seen, applications use cases that require censorship resistance. And that's very interesting, that's something that we've observed. So the first case, censorship resistance, is really something that most applications don't need. Most people don't need it, it's just for specific use cases. Now, what we've seen in reality, or observed, is really that a lot of people are actually using public blockchains because there is just a lack of working alternatives in a specific situation. So let's get into more detail about the two. So where or when is censorship resistance really needed? And here I'm going to take the example of Bitcoin. So let's break it down into the assets, so the currency unit, and the payment, the system. So first, it can provide you with financial sovereignty. So you have an asset that can't be seized if you properly store your keys. So the thing is, if you live in Turkey and you're against Erdogan, that would be a pretty nice thing to have. Similar, even if you're a member of the royal family in Saudi Arabia, this doesn't really prevent you, from getting your things confiscated if things change a bit. So it's something, even in developed countries, pretty interesting. For example, in the US, you have a procedure called civil asset forfeitures. So if you happen to be accused of being a criminal or whatever, your assets get seized or frozen, and you actually need to prove that you're innocent to get them unfrozen, which is pretty difficult if you don't have any financial resources. Also, a thing that's very interesting that you cannot do with other things is actually that you can transfer your wealth. So basically, with Bitcoin or other cryptocurrency, you can just store your cryptocurrency, so your entire wealth, if you want to, either on your phone, on a piece of paper, or literally in your brain, which is not the best thing to do, so I would not recommend doing that, but it's still in theory possible. So imagine now you're like a refugee from Syria, upper middle class, and you need to flee the country. So right now you can just take the basic necessities and you just leave your entire wealth there. But what if you could actually transport a significant portion of your wealth just in your pocket or even your brain? So that's something that is very, very powerful. Now moving over to payments, it's mostly really circumventing sanctions and blockades. So you have controversial examples, such as, for example, the Iran sanctions. So some countries don't really agree with these sanctions because they are unilaterally imposed by the US. But their financial institutions, they need to comply with them because otherwise they wouldn't get access to US dollars. So that's something that with the censorship-resistant payment system you can just circumvent. A bit more practical maybe, that's WikiLeaks blockade from 2011. So after they dumped all these cables from the State Department, the US didn't like that too much, so basically they told all payment processors to actually block all payments and donations to WikiLeaks. So what they actually did is that they started accepting donations in Bitcoin, and that's basically how they survive. But now about lack of practical alternatives. So this is really context dependent. So it really depends on the situation that you're in, whether using a public blockchain makes sense or not. So it's not about the censorship resistance here anymore. Store value. So I guess not a lot of people here in this room would actually consider Bitcoin to be a store value because it's just like so volatile. It's a bit the opposite. But on the other hand, it doesn't lose its value either. So if you're now, for example, a citizen in Zimbabwe or any country that has a lot of, well, high inflation, or hyperinflation even, it's, well, it may be a good alternative to actually something that you don't have access to. It may be very difficult to get dollars or whatever, and so the only way to actually escape inflation in these cases would be to actually go to Bitcoin. For people in developed countries, it's more about that they consider it as sort of alternative asset class, and not only Bitcoin, but really a lot of different cryptocurrencies or even these tokens now. So it's like an asset class that's largely uncorrelated to any other major asset classes. It has different risk-reward ratio. You can just use it for different things, like a reserve asset or even safe haven asset. So it's like a practical alternative to invest in. Now, cross-border payments. So I guess if you want to send the payment from, let's say, Britain to whatever, Luxembourg, where I'm from, it's just the existing banking system and financial infrastructure is pretty well. So it doesn't take too long. So you wouldn't really want to use Bitcoin for that. Now, if you happen to live in another country, so for example, if I want to send it to a third world country in Africa, for example, it can literally take weeks, and a very high percentage of the entire transaction amount is fees. So that's, for example, what BPISA is doing in Africa. So they help facilitate cross-border B2B payments, and they actually use the Bitcoin payment network as the underlying infrastructure to try to do these payments. Now, the same is true for remittances as well. It always depends on the country you're in and the existing alternatives that are there. So in Philippines, in a lot of Southeast Asian countries, you have actually companies that are using either the Ethereum blockchain or the Bitcoin blockchain to do remittance payments. So Bitcoin is, for example, it's running 24/7. There's no downtime. And what's very interesting is that the transaction fee is not proportionate to the transaction amount. So basically, you could pay the same fee for a $10 transfer as for a $100,000 or 1 million transfer. So the thing is, it's very interesting if you need to move quite large amounts of money across borders. And then finally, consumer payments. So if you don't have access to an online, well, to your credit card, or you don't have a PayPal account, maybe the only alternative that you have to do actually, or do an online booking or whatever, is really using a cryptocurrency, because it may be easier for you in that specific situation than just getting a bank account or a credit card. Now, well, Silk Road, for those who are not familiar with that, was the first, I think, well, at least the most famous darknet black market. And the thing is, it's just being used similar to physical cash in the analog world. So physical cash is still like the first payment methods for black markets. So if you have something like Bitcoin, it can be used as digital cash. It's just like very unsurprising. It's being used for online black markets. So because it's just the best alternative out there. Now, the two key questions to ask now are, when we want to design a new public blockchain system, so this could also be just a token or whatever on an existing blockchain, is really, do the benefits of decentralization really outweigh the costs? And I'll put long term into brackets, because in the short term, maybe it might seem that it's actually very, well, a very good cost ratio, but it's often hidden through subsidies. So if you take the block rewards, for example, in Bitcoin, initially, it wasn't used that much, and actually, because of the block rewards, subsidy of like 50 Bitcoin in the beginning, it was really the actual cost of using network was hidden. Now we are at 12.5 Bitcoin as block reward, and transaction fees necessary just have to rise. So the problem is really, this is about, do we need decentralization? And it goes back again to, do we really need censorship resistance or not? And I would really say, in most cases of most projects that I see, that's really not the case. It's not like the first or primary goal of the system to be censorship resistant. And then the question is, do you really want to use or build a system that is so inefficient and so costly if actually decentralization is not the main goal? Now, the second question, when you want to use an existing blockchain, that's a bit what we've seen just now, is that does the use of that system, token, or whatever, provides me with greater utility than just using any existing traditional alternative? And this is really, as we've just seen, context dependent. So it widely differs whether you're in a specific country, your situation, your goals, like it's very, very subjective. And this is why it's very, very difficult to generalize actually how cryptocurrencies are being used. This makes it very, actually you need to look at it from a micro perspective instead of a macro perspective. And also interesting, the last point is really that in the beginning, it may be better, more efficient, or less costly than an existing alternative. But going back to the point that blockchains are very difficult to scale, with growing usage, costs actually go up. So after a certain point, really the costs, again, outweigh the benefits. So people just move on to a better alternative. So this was it for cryptocurrency. So let's move over now to permission blockchains or distributed ledger technology, how it's being called now. The idea was really behind that, what if we just keep the blockchain? So basically, let's get rid of that unregulated token. We don't need it. It just creates headaches. Then we also don't need that very wasteful, expensive, and inefficient mining process. So how do we counter that? Well, we actually just restrict access to a set of known and vetted participants, and we use a gatekeeper. We make sure that there's nobody else who can just go in. So the idea is really having a shared ledger. So as Richard Genelbrand from R3 always calls it, is like, you want to know, well, you want to know that actually both of you see exactly the same thing. That's basically all it is. Now, the goal is really to preserve the characteristics that these public blockchains provide, but also have orders of magnitude higher performance and efficiency. And the problem is you need to use a completely different security model for that. So, as you said, we've removed the asset and the mining. So basically, this entire economic incentive design is that was the security model for public blockchains and cryptocurrencies. But in permission blockchains, it's really based on access control. So the guy over there who makes sure that nobody who's not approved can enter the system. And second, you have these known vetted participants, which are generally regulated entities. So you just establish legal contracts between them. So now the security model is really based on a threat of legal action in case that there's misbehavior, because everybody can still realize if somebody is cheating, so you know exactly who's the cheater, so you just take him to court. So that's completely different security model. So it's very important to understand that blockchains is really all about trade-offs. So you can't just take like all the benefits of it without any of the downsides. So it's really all about trade-offs. So you can see that public blockchains, they have censorship resistance, but that comes at a high cost of decentralization, so being very inefficient, costly. Whereas these private blockchains, they're just very performant and efficient compared to public blockchains, but they rely on a completely different security model. So we have a very enormous hype of blockchain use cases. So these are just like randomly selected news headlines. So it can change like literally everything, reinvent the supply chain, can even stop climate change, save the planet, and it even gets better, it can change the world and our lives. So I honestly have to say I'm a bit skeptical about these things. I don't think blockchains can do that. So let's take a step back and actually see how you can actually use a blockchain. So there are basically three ways. First is you issue new native assets. So that's for public blockchains. Some permission blockchains as well. Depends on how you want to use them. So basically you create a new asset that lives, so its existence and ownership is really defined by it being on the ledger itself. So it only exists in that ledger, not in any kind of other database. And what blockchains are pretty good at is creating digital bearer assets. So what that means is that it's similar to cash. Cash is a good example of a bearer asset. If I hold it, so I hold the private key in this context, then basically I own it. Nobody can take it away from me. So this is, for example, what the UBS is doing with something what they call smart bonds. So bonds would be a very good example of creating these digital bearer assets. So having a closed network of some banks that trade bonds between each other. So the bond is being directly transferred. Now, you can do something similar, but there is a very important distinction between it. So that's what we call tokenization of existing assets. The term token is being used a lot recently, but in this context, it really means that you represent an existing asset digitally with a sort of token. So the asset actually exists outside of the blockchain, but the token represents that asset, and you actually just trade the tokens. So this is what the Royal Mint is doing with, I think, BitGo, CME Group, with digitizing gold. And then C is really just using the blockchain as a record-keeping system. So that's what most blockchain use cases actually would do. So basically, you take any external event and you record that event on the blockchain. So It's pretty popular for supply chain applications and so on. The thing is, there's really a distinction between A, B, and C. So B and C, the blockchain has no reach over the asset or the fact that it wants to record. Whereas on A, it really lives on the blockchain, so the blockchain can enforce something. And so that's the thing where there's like this difference between what is expected from blockchains, so the page that we've seen just before with all the news headlines, and actually, on the other hand, what blockchains can actually do. And so it's very important to understand that the blockchain cannot enforce something that's outside of its reach. So every time actually you record something that's outside of the blockchain, it's just like a complete separate system. The blockchain has no idea what it is recording. So it needs to have a sort of trusted party on the edge that makes the connection between the real world. So there are common misconceptions about blockchains. So first one would be really blockchains are trustless. So as you've just seen, there's a gatekeeper that needs to set up the entire onboarding process for permission blockchains. And if you do either B or C from the previous example, so you interact with the real world, there needs to be at least one or two trusted third parties that actually provide the inputs to the blockchain, because otherwise it wouldn't really know what it has to record. And so there we come to the second myth. It's really blockchains are not truth machines, because it's very simple. If it's garbage in, it's also garbage out, or the garbage stays on the blockchain. So it's not that because something is on the blockchain that it's magically true. It's just like you need to trust that the input is actually correct. That's the first thing. And then second, you need to trust actually that the records from the blockchain corresponds to what happens outside in the real world as well. So they just don't magically make things true once they're on the blockchain. This is actually my favorite. Blockchains are immutable or tamper-proof. So, like, there's nothing like absolute immutability. It just doesn't exist. So even public blockchains carry probabilistic immutability, which means that over time it gets very complicated to change past records, but it's not impossible. And now with permission blockchains, technically seen, literally just takes a signature to change the block. That's it. Of course, you have all these legal contracts and so on, but from a technical perspective, it's just a signature to change past blocks, which I wouldn't necessarily consider as being immutable. And then finally, one of many misconceptions is really that somehow people think that if they put something on a blockchain, that makes it 100% secure. And secure in the context of blockchains really just refers to the fact that how likely is it that past records can get changed. That's the kind of security you're looking at when you're talking about blockchains. But if you think you put your data on a blockchain and then it just becomes secure from hacking or something like that, that's definitely not the case. It's rather the opposite. Instead of having one honeypot with the data, you have now created hundreds of different nodes that carry exactly the same data. So it doesn't make it magically more secure. So why am I all telling this? It's to better assess why actually we haven't seen that much adoption right now. The thing is, we've witnessed a quite move from blockchain to what we call now distributed ledgers or shared ledgers. So it really seems that a lot of people have realized that this particular data structure that we call a blockchain may not actually be the right or most efficient way of doing things for a lot of applications. So R3, for example, they were one of the first of really clearly stating, we're not building a blockchain, we're building a distributed ledger. Also, second realization was really that it's really the most inefficient way of doing if every single node does every single thing. So basically, why should a node only process transactions that they are really involved in, so in a specific trade? So yeah, the thing is we have a lot of high-profile projects that have been announced during the last 2-3 years, but we haven't really seen a lot of them really materialize. So one of the exceptions would be ASX, which was announced, I think, 2 days ago or 3 days ago. But yeah, so many projects have just started the proof of concept stage, or still like in trials. And if you've seen actually real deployment in production, it's like very small networks, so 2 to 10 nodes with like 4 or 5 participants, which is interesting. But the thing is, really the value is created at the network level. So you have like a very, very small network that often also just runs in parallel with existing systems that just isn't like the revolution that we were expecting, at least. So what are the key reasons for that lagging adoption? I think it's interesting to look at that model to explain that. So just very briefly, at the base layer you can see the protocol. So that's literally just the code base. So the frameworks, To give you an example, it could be chain core, it could be Hyperledger Fabric, Corda, whatever. So that's like code, mostly, most cases it's open source, you can just grab it. But the thing is where actually the real value comes from, that's like the network, that's where these blockchains come to life. So one example would be the Nasdaq Link blockchain, which is a specific network between Nasdaq and some of its traders, and it's built on chain core. And then you have actually applications that plug into these networks to just use them and get some data from them. Now, the main problem is that we're still stuck at these two layers here. So the protocol layer is really maturing, so technology is getting better and so on. But the problem is for customers that want to build their own networks, it's really like they don't know what platform or what protocol to select, because most of them are not interoperable, and there are actually a lot of different protocols you can choose from. So what if you choose the wrong one now, and then later it's just like another winner emerges and you're just stuck with the wrong protocol? That's like one of the reasons why they prefer like building small networks, build on different kinds of protocols just to experiment. And the second reason is really we haven't seen a lot of large-scale networks deployed yet, and that's where the actual value of a blockchain lies. So if you have a blockchain with 4 or 5 nodes, well, that's fine for a specific use case maybe, but not beyond that. So there would be no application really interested in plugging into that. But if you've got now a network like Swift, for example, with thousands of banks being on one single shared ledger, that would be something very different, because really the value is created at the network level, so a lot of applications would actually be very interested in plugging into that. Now the thing is we're not there yet, so we haven't really seen any real applications. So I took City as an example, but actually it's not really an application, it's more like a plugin. That's because I really couldn't find any single application where we have like the full stack there. So we're really still stuck at the protocol and the network layer. So why is that? It's really, we're talking about shared ledgers, shared infrastructure, and so building shared infrastructure or market infrastructure is really, it takes a lot of time. You need to be very careful to deploy it. So it's not like simply deploying an application, so that's why it still takes time. So now I'm going to quickly wrap it up. So again, public blockchains really specifically designed for censorship resistance, which comes at a very high cost. But interestingly, we find out that at least right now, in specific situations or contexts, it still makes sense using them, because the existing alternative from traditional system is just either lacking or even worse, which speaks volumes of the state of that infrastructure actually, but yeah, that's another topic. Yeah, permissioned blockchains, they just take different design choices. They want to increase efficiency and performance, but that involves trade-offs, I've just seen before. Then we're back to the fact that blockchains are not silver bullet. They just don't create magic out of nothing, but they're just a specific tool that you can use, and you know, well, you should know how to use it. And for that, you really need to be aware of the limitations. And finally, what we've just seen actually is lagging adoption on corporate, so most projects still have to materialize. That's it. So I guess we may have some time for a few questions. So.
At the end of the slide there, you had 2 protocols at the bottom. These things are economic. Do you believe that the world will consolidate on one protocol? And if you do, where would you put your money?
So to what kind of blockchain does that refer now? We're talking about public?
Public.
Well, I'm not giving any investment advice, but right now it's very easy. Bitcoin has the largest network effect. So it's the most liquid currency, it's the most liquid asset there. You can literally use it all over the world if you wanted to. It's still the most secure blockchain, so I guess changing past records would be a lot more difficult than all the others combined. And it actually has a lot of real use case right now. So Ethereum is very interesting, but it's still very early stages, where a lot of people keep actually forgetting. So it's, 3 years old now, or even less. And now Cryptocurrencies seem to be like one of the main applications of it, which is fine. But yeah, so a few Cryptocurrencies can already clog the network. So it's still very early stages. So right now, really, Bitcoin is the most advanced blockchain, although a lot of people keep actually saying it's very conservative, but that's the entire point of it. So,
have you seen any scalable proof of stake chains?
That's the thing, yeah. You have like BitShares and some of these other systems that use proof of stake and some other techniques, and they claim that they're actually more scalable. The problem is really these chains have not been really seen, well, have not seen a lot of usage yet. So right now, it's very difficult to verify these claims. So maybe it would be interesting to do some stress tests. So if anybody would be interested in doing that, that'd be nice. But yeah, right now you can't really compare these because, in my opinion, they haven't been really beta tested yet. So they haven't proven themselves because there's just not enough usage for it. So in my opinion, it's still claims. It would be great if they turn out to be true. But I'm personally a bit skeptical right now about proof-of-stake systems, whether they can really deliver what's being promised. So we need more beta testing.
All right, great. Thanks very much, Michael.
Thank you.